Good Tuesday morning, guys. My name is Jerry Miller, and welcome to Real Talk, an insider's guide to real estate life and the pursuit of happiness. We are live in Charlottesville, across Albemarle County, Central Virginia, the Commonwealth, and the world on the I Love Seville network. Today's show, a fantastic one. Scott Morris is in the house. Michael Buczynski is in the house. Another roundtable here on Real Talk with Keith Smith lighting up an all-star cast of characters. You can get involved on the show by offering your perspective in the comment section, sharing your thoughts, sharing your ideas. We will relay that perspective live on air on Real Talk, whether it's Twitter, Instagram, Spotify, YouTube, any social media network possible. Periscope.
There you go. Thank you.
Keith Smith's favorite right now, Periscope. Keith, I will get to you in a matter of moments. This gentleman is fixing the microphone. The camera.
The director is hard at work, but I'll chat a little bit without a camera on me. How's that sound?
Yeah. So, well, go ahead.
Yeah. So we're trying to move into this month of doing roundtables, kind of focusing a little bit on back on the real estate market and some of the questions we get asked all the time, right? And a lot of these questions that we get asked all the time is, how's the market, right? But we're going to focus a little bit today about things from a mortgage perspective, right? Where's the rates today? Where's the rates tomorrow? Where are these two gentlemen to my right who are rock stars in the business that hopefully get us a little bit smarter about the future of rates and the future of the mortgage. And we're going to talk a little bit about this forbearance thing on the back end of it and see what these gentlemen think about that. But I'll hand it back over to you and let you do the intros, and we'll take it from there.
Let's go our four squares on screen, and we'll start with Michael Buczynski. First, I believe this is your third or fourth rodeo here in the I Love Seville network in our studio. Before we talk shop, how about just an intro to Mike?
Sure. My name's Mike Buczynski. We live in Crozet. My wife Sarah and I and our two kids, Ava and Noah. And I've been I've been a mortgage lender for 20 years now, and been with my current company, First Heritage, for going on 7 years now. So that's me in a nutshell. Nothing too exciting. Just dad and work a lot.
Loves basketball. Is a
yes.
Dad? Outdoorsman.
Yes. Yes. Love Crozet.
Got a beautiful better half.
I do. Training. We're both actually, I am and she's going, we're training for an elk hunt in Wyoming at the end of this year, hopefully.
I didn't know that.
Yeah, so that'll be fun. And
you're going to go kill a helpless little elk?
They're not helpless. They're like...
It's an outdoorsman. And they're definitely not helpless.
I'm just kidding.
And they're delicious and tasty. So.
That's right. Scott Morris is in the house. Scott, we chat with you all the time. This is the first time in person.
Live in the studio.
It's great to see you.
Great to see you guys.
I feel like I've known you forever, but literally the first time I've seen him in person, which is a byproduct of 14 months of COVID-19.
Yeah, it's been crazy.
And screen fatigue. But before we talk rates and shop and real estate, how about an intro to you?
So I've been in the business 5 years. I've got a background in the Marine Corps, and then locally here in Charlottesville with a car dealership. And I've got 3 little kids, all under the age of 3. I've got identical twins that are about to turn 3 and a 9-month-old baby. My life is not very exciting. I cut a lot of grass, and I've got chickens. They're kind of cool, if you're into that sort of thing. So that's about it.
We got a talented mortgage guy from Madison.
Culpeper. Culpeper, a little further north.
Okay, Culpeper, sorry, Culpeper. And one from Crozet, Keith Smith.
And 2 guys having a cup of coffee.
Yeah.
4 guys having a cup of coffee.
I feel lucky here.
There you go. So, look, I put this in a little, I'll start with you, Scott. I put this in a little bit of perspective from my end of it. Everybody's kind of talking about interest rates and where we're going. We're just going to bat this one right out of the box here. When I started, I bought my first house, and I've said this a couple of times. What's the number, Jerry?
18%.
18%.
Yeah.
Right? So the first slide goes back to 2016, which Judah will put up on the screen, but it shows a 5%. But, where are we at today? Where's your crystal ball showing we're going to go? And then we're going to get Mike in the mix on that here in a minute.
Well, mortgage rates have been on decline for the last 30 years. But to be where we are now is a pretty incredible low, even though we're kind of off the lows from December. But I think everybody projects that we're going to be back to 4% towards the end of the year going into 2022. And a lot of that's dependent on what we see in the U.S. bond market and what they're predicting as far as that being back in the 2% range, and then the government getting away from buying $40 billion a month in mortgage-backed securities, which is what's keeping rates as low as they are at the moment.
So, Mike, talk about mortgage rates. You know, what's the magic of it? What creates a 30-year mortgage rate? What causes this trend to go up and down in the layman's terms?
It used to be the mortgage-backed securities market. Now it's in my opinion, it's just pure insanity. I don't know how we get back to normal checks and balances on interest rates when we have, when we're 30 trillion in debt. So my concern is I don't know how we get back to actual rates monitoring themselves. The federal government has suppressed rates so low for so long, they've almost created a Frankenstein where I don't know how you get out of it, right? I mean, how do you raise interest rates when you're 30-some trillion dollars in debt? How do banks lend to each other? How do businesses stay open? I don't see them going up. I mean, despite whatever reports say, I don't see how they go up. There's projections, but there's been projections all along about rates rising, and when I first started out, I think they were 6%, and that was incredible, right? And everybody was going nuts to refinance, and a 15-year fixed is in like the low twos right now. So I don't know how. To answer your question, the traditional indicators are not in play anymore, it seems like. It's the federal government has just changed the game by quantitative easing and just purchasing all these mortgage-backed securities and bonds in the open market, and I don't see how they stop. I don't see an exit strategy. If someone else sees it, please tell me, but I don't see it.
So is this Scott, is this like this musical chairs? Do we have a situation like that going on?
You're talking to robbing Peter to pay Paul.
Sure,
situation.
But I think part of that is in the mechanics that they've at least forecasted that they're going to try to stick by, which is as we have a jobs report that comes back in closer to 5%, which we might get Friday. There are going to be people in the Fed that are going to start talking about taking away some of the Fed's policy still has its foot on the gas. They're not talking about hitting the brakes. They're just talking about taking away some of that mortgage-backed security buy. And as that comes off the table, you're going to see rates be forced to go up because it's going to take away some of that juice. I mean, they're literally taking it out of the investors' hands, and the federal government's handling it. As more investors are forced to take on more risk, the price of mortgage rates are going to go up. Now, are they going to go up overnight? Probably quickly, in probably a 2 or 3 week period, and then they're going to get back to a plateau where, kind of like when we saw this little spike a month and a half ago in the U.S. 10-year, where we climbed up a little bit, and then everything sort of even out again. But when and exactly how that happens, I don't have a crystal ball, but it's on its way.
So you're talking a plateau of threes, high threes?
Yeah, I think it'll go to high threes and then stop, and then they'll take a little bit more money off the table, and it'll go up a little bit, and then it'll stop. But where that eventually ends, the government will step in and then juice it again in some other format with this first-time home buyers $25,000 purchase incentive. They're going to keep adding to the fire, but they're probably going to do it in different ways.
I'll throw this to Mike and then you. We've speculated, we've bantered that increased rates could stabilize this out of control market.
That's where I was going to go.
Any take on that for you guys? You're in the game. If we increase rates, we minimize a little bit of purchasing power for buyers, which means we could potentially diminish a little demand, which means we could stabilize the market potentially.
That would have to be, in my opinion, they would have to raise and stay for a while.
Okay.
And there's a lot of other factors that would probably have to come into play as well. I don't think a rise in interest rate. So, like for example, if you do a $400,000 loan and the rate's 3%, let's say it goes to.
Say it goes a point. Say it goes to 4%.
Let's say it goes
Easy
to 4%. Math. That's $223 more.
$223 more a month.
Yeah, No, not a month. Yeah, I'm sorry, a month.
$25
So
a
that comes
quarter.
out to
That's about right.
$2,600 a year. So $2,600 a year for someone buying doing a mortgage for $400,000, I don't think is a make or break type
An extra
number.
200 and change?
For that price point, I don't see it. I don't think it would be.
Well, you know it.
So I don't know if rates going up to 4% is going to stall it that much.
Let me try it a different way.
Sure.
Right. Let me try the question a different way.
Sure.
When we talk to folks, it's less about rates. It's more about monthly payment and then how much house I can buy for monthly payment. Most folks, I mean, they see the rate, they kind of get, oh my God, but the reality of it is, how much house can I buy for my monthly payment? So Scott, when you sit down with somebody for the first time, is the conversation about rates or is the conversation about how much house can I afford? Is that making any sense?
So it's less about rate. Let's talk about monthly payment. Let's talk about what your ceiling is, where you're comfortable, and then where we're going to make a decision going from there. If it's, what it will take away is the people that are shopping at the top of their price point, or at least it's going to change that price point. So as that shifts, hopefully we start seeing, more days on market for some of these properties, and that's going to help stabilize pricing, in my opinion.
Today, what's the rate today? 30-year fixed, decent credit score?
It's like 2.8 around there.
So it's still under 3.
Mm-hmm. It dipped under 3 about, I don't know, maybe 2 weeks ago?
2 weeks ago.
About that.
So
Yeah.
I ran numbers this morning from 2000 to 2020 about number of units that sold, prices, what I was looking at a year-over-year increase. So the last time, according to our slide 1 from Fannie Mac, Freddie Mac, the last time the rate was at 4 was roughly 216. In 216, just to put it in perspective, there was a 5% increase in value and equity. So even at 4%, homes were still appreciating year over year. And the reason I bring that up is you're starting to hear people, should I wait? Is now the time to buy? And our answer obviously is now's the time to buy. Either one of you gentlemen want to jump in on that? Is it time to buy or should I wait? Does that make any sense? Jump in, guys.
I mean, I think people get comfortable based off of the market around them. Like because I think of it this way. Everybody was looking to buy homes and was comfortable when rates were 4% and 5%. And granted, their purchase power was a little less, but rates are sub 3%. I mean, what else are you waiting for to jump in on? Now, the problem we have, as we've discussed in the past, is there's just no supply. So if ever there's supply catches up to demand, I won't see my kids will be working that much. But I don't know if a 1% interest rate increase is going to stymie the market that much. I don't think it will. I think folks will be comfortable, say, all right, it's gone up $200. We want a house. We'll figure out a way to make it work.
And to your point, 4% is still ridiculously low.
It's insane.
It's a great rate. Yeah.
Yeah, when it hit 4%, we were like, this is the lowest it'll ever go. And then
Right.
it hit 3.5, and it's the lowest it'll ever go.
We-
My point to that is I don't trust the projections anymore because everybody's like, this is it, and it'll never go low again. So it's just, there's too many things that have been artificially put in place to manufacture our rates now. So the market has a challenge to right itself naturally.
So when you talk about the benefit of buying now versus waiting, here's the benefit. Let's say it goes up to 4%. So we move a full point up, and you've gone from paying a third of your principal in addition to interest at 2.875 to paying not quite 2/3 in interest, and you're expecting prices to come down $40,000, but now you're making $80,000 more in interest payments over the term of the loan. So is the benefit to wait to save the $40,000 that you see on the big number if prices do correct that much, and you're still paying another $40,000 more than what you would be if you purchased now? I don't see the benefit there. The benefit is if you can get in even at a slighter higher price point at a much lower interest rate, there's your plus.
Yeah, I'll add to that. I don't think people are looking at interest rate 100% in determining if they're going to buy a house or not. I need a house. I have a kid. Moving, I mean, if you need a house, you need a house, and the rates are just going to be what they're going to be, and we'll have to figure out how to fit all that in.
So part of the reason I wanted to have this start off this month with the mortgage guys, because at the end of the day, the first thing you're going to start with is how much house can I afford before you go out and start looking
These
for
guys.
these guys.
Yeah,
I mean, this is
yeah.
your first.
Here's the gatekeepers.
This is the first step in the process. But we talk about this all the time on the show, and I've been saying it for, God, it seems like a year now. And I think it's happening. I always was concerned that everybody thinks sub 3% is norm. It is not the normal. It's not even close to being normal.
He's alluding to that this could be the new norm, at least in this range, for a little while. I mean, if the federal government has accrued so much debt, is the federal government going to increase rates and make itself pay more interest on that debt?
Well, we talked about this last year. I've been in this game since 1987. I'm looking at something that Freddie Mac and Fannie Mae and the MBA, Mortgage Brokers Association, they're projecting out to 2022 that this is going to stay under 4, at least the reports I'm reading. I mean, in 3 decades, I've never seen anybody say, well, I think this is going to be
He
okay.
also is alluding to you probably should disregard the projections. Isn't that also kind of what you're alluding to?
They've been wrong so much.
Sure.
I don't know how. I don't have a lot of faith in them anymore.
What do you think, Scott?
I mean, I think with the debt, the interest and inflation is what gets us out. I mean, it needs to go up in order for there to be more margin for them to accrue more money to pay for the debt that they've established.
So I'm going to ask the question: Are we building another bubble here, guys? Right?
Yeah, of course.
You think so, really?
How can you as a country be 30 trillion in debt and not be in a bubble?
A housing bubble?
Just an economic bubble in general. What?
That's
Mona
interesting.
Daniel's giving you some props here. She says you're her favorite guy here. She also threw Keith and Jerry here, but I think
Thank
the
you,
financing may have
Well,
come from this guy over here.
Let's be honest. She threw Keith and Jerry under the bus.
Okay, she says Scott's all right. Scott's her favorite guy over there. A lot of people are watching. A lot of questions. Finish your thought here, Michael, and then we'll get to the questions here. A lot of questions for you two guys here.
But my whole point to that is it's a very difficult exit strategy to start to increase rates. If you increase rates in theory, you slow the economy, right? So I don't know how they've, like I said, they've created a Frankenstein where I don't know how you do that without really damaging or hurting people trying to recover out of a pandemic. I mean, it's a really difficult spot to be in.
So you just gave me an idea for another roundtable. We're going to ask Lisa Sturtevant to come back in, and then another economist to really dig into what you just were saying from their perspective to see. I don't see it the same way, but I
don't see it the same way because in this particular bubble, the owner of the house has not been using his or her house as a piggy bank. They've been instead accruing equity. As opposed to refinancing and taking money out. That's what you're saying.
So I think Michael's talking
forbearance.
more about the macro side of things, which I don't disagree with you, by the way.
Sure.
But as far as housing is concerned, this is not a repeat of
people have more equity this go around.
There's not a massive tidal wave of subprime adjustable rate mortgages that are about to come and go, explode the market and come due, and then massive defaults.
Well,
that's probably not on the.
Well, let's get to this forbearance thing after a couple of questions.
And we also got to get to the 1031 exchanges, the Starker exchanges, and the potential elimination of the Starker exchanges, the 1031s, and how that could impact commercial landlords, the little guys over here. Okay, we need to get to that. But multiple people are asking, and you guys have already touched on this, guys. Do you get this question constantly? Rates, where are they going to go? Constantly getting this question?
Mm-hmm. I mean, when we saw things move so quickly from where they were to where we are, and it's the number one question anyways, but I think Mike alluded to it earlier, it's a question people like to ask, but it's not what drives their decision making. I mean, it really doesn't. If someone needs to make a lifestyle change, the rate is not going to be the biggest thing that impacts them. It's going to be the payment and where the house is and 100 other things.
Cole, here's a good question that just came in. Colby Romasco is giving you props. Dr. John, the owner of Pro Renata, is giving you props. We love Pro Renata. I love the hop drone, John. That's a great freaking beer. This is a good one for you. Zoom Towns, which came up yesterday. Jennifer watched the show yesterday with you and I, and she says, ask the guest about Zoom Towns and how many mortgages have been processed where it's a family or an individual that's working out of market, coming to Charlottesville, setting up shop. It's now called a Zoom Town or a digital nomad, where they're able to work from the ISP while earning the big city paycheck. How many of those?
It's like telecommuting.
Yeah.
In essence, yeah.
Digital nomad.
Yeah, we're already doing that now.
Yeah. How many of the mortgages have you processed or put through the pipeline for folks that are moving here after selling a big, like you guys? Didn't you sell a huge townhome in Northern Virginia or a townhome in Nova? No. Okay, a lot of people are doing that.
The bottom line is number 5 in the country
Yeah.
for retarees to come here.
Number 2 for retirees, according to Realtor magazine. Parade magazine, top 5 in the country for retirees moving here.
Number 1 location for first-time home buyers is Harrisonburg, which, you know,
Wayne's throw Waynesboro in there too. They got ranked as well.
Waynesboro's number 3.
Yeah.
I think the question is are you seeing a lot of out of the area buyers coming in?
That's the question.
Is that the question?
Yes, thank you.
You want to?
Yes, but I think prior to the show, we kind of alluded to this. So from a mortgage perspective, it's about proving from their workplace that they can continue to work remotely. And then we've got, these bigger players in at least the finance world, which is going to trickle down into other job scenarios, that how long is that going to be sustainably allowed? Everybody likes to think, well, I've been doing this for a year. Why can't I do it forever? There are some job places where if you're not there interacting with the other humans, you're going to be left behind. So that may go away, but I've seen a lot of it. I mean, I've got somebody who's works currently in Saudi Arabia who's gotten permission from Aramco to come to Charlottesville and,
And buy a house?
get done.
And get a 30-year mortgage?
Done.
Get out of town. Oh, such a crazy time we live in.
But 100%. And it's historically been that as long as I've been here in '87. We're always been on the top 1 through 10 of some list at that point. But it's interesting. We were talking about prior to the show about the Zoom Town. I have a 1:00 meeting in Fulvana County, and I'm 1,000% convinced that we will do this hybrid. Right, it's just going to happen.
But to Scott's point, last week, Jamie Dimon, CEO, J.P. Morgan Chase, says his team is coming back to the office. Today, Goldman Sachs responds to J.P. Morgan Chase and says their team's coming back to the office this summer. To his point, it's creating a keeping up with the Joneses effect of getting back in the office. Isn't that what your point is?
Yeah.
But that's laser focused to a specific
But the finance
industry.
leads the... I mean, you may disagree.
There's
a
a little argument going on currently about teachers going back to schools. I don't know if you've read about it in the news, but they've lobbied the CDC, and this isn't a political thing. This goes back to how long is everyone going to be able to work remotely, and that's a question mark.
It's, in my opinion, for what it's worth, and Michael,
Let's get Mike in here.
Jump in. I think it's, and again, where it's not rates and mortgage, but it's I think it's going to be industry specific. I really do. Teachers, obviously, eventually going to
Teachers
have
got to go to school.
Gotta go to
They
school.
got to be like kids.
they got,
Yeah.
and
Right?
I don't disagree with that. Yeah.
I can tell from, I know this because
Keith, you got a chuckle out of that.
my daughter is a teacher, so she's like, I want to get back into school and all this stuff. But in my
So do the parents.
But in my
Parents want the kids in school.
I think I'm the only guy here that I'm okay with
Yeah,
that.
right.
I'm the empty
Now
nester.
you are.
Mike, jump in, buddy.
I think it is industry specific. For my job, I would say virtually 100% of the clients I did loans for last year it was completely virtual. We have apps now on our phone that can do the entire loan application, upload documents, and for my job, what I have found and where I think helps me excel is that I realized very early on that folks don't really, it's very inconvenient for them to take 2 hours out of their day to come sit with me and bring a whole bunch of paperwork and try to do that. If I can show them how to do it, virtually, very efficiently and quickly, it saves them time and it helps me develop that relationship and earn their business. So I don't think clients, there's some that are old school and want to come and sit down, but I think the whole COVID thing showed the way of the future in that a lot of businesses are going to continue to do telecom type business. And for my business, I don't see any change. I could live anywhere in the country probably and still do my job efficiently.
So therefore, it's specific to industry, right? So
100%.
I have a 1:00 meeting today. It's a technical review committee. It's a planning development kind of thing. Normally, we would be in person. There'd be 6 people coming from 45 minutes to an hour to a location. We're now doing it on Zoom.
Yeah.
It'll be done in 45 minutes. I got my bike on the back of the truck. I'm not spending 2 hour and a half going back and forth. I'm going to go do a bike ride.
Time, your most precious commodity.
Just be efficient. Just be efficient.
Yeah.
But
Steve Harvey, welcome to the broadcast. He's watching in Crozet. Hello, Steve Harvey.
But my haircut's not going to be cut remotely, right? So,
Yeah, that's true. Mona Daniel says if a client has a great need to move, they can't wait on the rate forever. She says rate is definitely a bonus, but I agree with Scott. If we need a house, we just get a smaller or cheaper house to make it work for our budget.
Or if they're selling and they're selling and they're having a little bit more, revenue from that sale, they can buy a rate down. Can't they buy a rate down, guys? Mm-hmm. Right. So talk about that. How does that work? So if it's at 4% and they want to buy it down to 5%, or maybe that's too big of a jump. Scott, talk about how that works.
Talking points.
So there's, we're talking about the cost, what par is for the day, and then you're generally going to pay to move about an eighth, and then there's various degrees on, some pricing is actually a little bit lower than where you might think it is, and you need to look at everything that goes into it. A lot of times when you're shopping, I'm sure Mike can agree with this, there's some online banks that are charging huge origination fees, and that all they're doing is taking that money and then pack it in the points anyways to show this discount rate that you see in the advertising.
Yeah, to add to that, if you pay 1 point, which is basically 1% of your loan amount, allows you to buy your rate down a certain percentage point. So if rates are 3%, you pay a point. Typically, you get maybe a 0.25% lower in rate, but that's about your biggest bang for your buck. You can't then pay another point and get another quarter, another point, another quarter, because the banks are cutting off their yields. Because
Sure.
what happens is when you're locking in these loans, they're buying a security on the market, and at some point, it's just not financially feasible for them to do that and offer that rate. So as you're paying a point, if you're going to stay in the property longer than the break-even point for that point, totally makes sense to pay points. If you're not, don't pay points. You can invest that money into something else.
And the simple math on that is ask, whomever you're working with, okay, what am I saving to go from A to B, and then divide that by the cost, and that equals the number of months, and that gets you to where you're looking to go.
Pivot a little bit, guys. This fallacy, this thing.
20%?
There you go, buddy.
Yeah, I know, the chemistry.
Yeah.
It's weird.
It's
weird.
It's really weird, but that's okay. It's fun. I love it. So
That's how it was drilled into my head growing up.
Yeah.
20% down.
You couldn't buy a house without 20% down.
Well,
that's all my dad would tell me growing up. But it's a myth.
Who's the guy? The super conservative
Ramsey?
Yeah. So all these
Ramsey.
people, Dave Ramsey's been coaching to come up with this 20% down payment. Who over the course of the last 4 or 5 years, instead of paying 5% down, they've watched the housing market, get to a price point that they could have saved thousands and thousands of dollars by acting versus
So if I can get an interest rate of 3%, right, and if I buy a $400,000 house, I'm going to drop $80,000 to get 20% down. Or in theory, I could put less down, right, and invest that money. You can't tell me I can't make more on my $40,000 or $80,000 than 3% right
No
now.
doubt. Yeah.
So
Index fund.
every dollar you put into the mortgage transaction is dead money. You have to pay to get your money back out. You have to pay a real estate agent. You have to pay closing costs. If you can purchase a house and the payment is such that it works for you and you can keep your money liquid, especially considering everything we've gone through, you don't know what could be in the future. I would recommend keeping your money liquid and investing it and earning that interest, especially if someone's selling a house. You sell a house for $400,000 and you're going to buy another house for $400,000, you just pay cash. Why not invest the $400,000 and let your money pay your mortgage for you?
So literally, that's the question I want to ask next, you gentlemen, because after this is over, I have to call a client to answer this question. So I'm going to ask it of the two of you
Tell them to
all.
put the money in an index fund or in an ETF.
No, so here's,
And the return is going to be better.
so here's the question. We're negotiating to buy a home, multiple offers. The buyer can do it in cash or go get a loan, right? So from my side of the table, if they do it in cash, my position's a little bit better to get the house. But what they're doing is the opposite. They're now taking their money out of their ETFs or whatever they're doing to buy the house, right? Because they want the house, they want to use the cash to do that. So the question that was asked is, okay, I'm going to buy the house cash now, and then I'm going to refinance it.
Sure.
Let's talk about that. What does that look like to you, gentlemen? So in other words, I've got a buyer. We're going to buy it in cash so we can win the day, so we can get the house because they desperately want it. So that's been my advice to them. And then say, look, guys, you close, reach out to Scott, reach out to Mike, and refinance it. Does that make sense? Is that good advice for a buyer at this point? Does that make sense?
I mean, it totally makes sense. And it's really their level of comfort with cost. I mean, because they're gonna pay closing costs again, but at the same time, could they conceivably make
But if they
much
do it
more
in
than
a
that?
loan, they're going to pay closing costs now, right?
That's what I'm saying.
So
Well, if you purchase a home, you have costs. You have recordation taxes, attorney's fees, and stuff like that, right?
but
Then if you
that's pretty minimal.
It's thousands
It's
of dollars.
a couple $1,000, recordation taxes. The city's not giving it away for free. Or the
That's
county.
true. You're right.
So if you refinance, you pay the majority of those costs again.
But
And
I'm
then
not
you have
winning the
lender
day,
fees.
though.
What's that?
I'm not winning the day, though. I'm not getting the house.
See, and that's the challenge you have is because what's best for the client may not be best to get them the house. Like if they can get a loan and invest their money, that's better for them cost-wise and investment-wise.
So I'm paying cash. I'm not playing this bidding war thing.
Sure.
Right? That $5,000 I would have spent in a bidding war anyway. So let me close it on cash. Spend
Sure,
it.
and again, that goes back to what are they most comfortable with? And if they're good with doing that, like, then,
Oh, by the way, this is not every buyer. Every buyer doesn't have a ton
Yeah,
of
no-
cash.
Yeah, sitting on a pile of money.
Yeah.
In this particular case, it's a scenario you talk about all the time. Moved out of the Northeast, sold their home, got the cash,
Yep.
and they're asking me what's the best path for them to do with this cash.
How do these guys feel? This question's on the feed. How do you guys feel about all these offers where it's take a loan to its max potential and then the buyer then comes in with cash on top? How comfortable do you feel doing deals like that?
I mean, it's supply and demand,
Yeah.
right? I mean, they've created a feeding frenzy for folks. And my job is to provide people with financing for the home they want at the best terms and deliver the best service, right? If they choose that what's best for them financially is to write a contract and agree to bring another 50 grand should the house not appraise, that's their decision. I don't necessarily know that that's the smartest decision.
Does that make you trepid with what you do?
who's
That
the
they-
buyer?
No, if they qualify, then that's like I said. That my job's to lay out the pros and the cons, and they make the decision.
Gotcha.
If I'm not going to do it and they're bent on doing it, they're going to go see Mike and they're going to get it done, or vice versa.
Gotcha.
If Mike, our position it's to help them execute a plan, and however they're committed to executing it. Now, if they are a first-time buyer that might be out of the house in 5 years, do I at least say, hey, you need to think about think about
The risk
the actions
profile.
that you're taking.
Yeah.
Now, if this is someone who's like, hey, I'm moving in from a more expensive market and I'm going to be here for a long time, go for it. Spend the money. Do whatever you want. But you should at least give some consideration to the fact, for first-time home buyers, if 5 years from now they, outgrow the home, have a lifestyle change, God forbid, get divorced, whatever's happening happens, and then they have to deal with the consequences of their actions now, it should be thought about at least.
Average home buyer as of 2020 is in their home for 9 years now.
Yeah, it used to be 7.
Yeah.
Used to be 7.
Yeah. Pam Garrison says, "What up, Mike?" She's
Pam.
giving you some props right now. This is an interesting one that's come up. Jerry, ask your guest about your San Francisco comparison. So San Francisco, we all know, you have Stanford there, you have technology exploding, you have a housing market that's unattainable. You basically just have a white rich playground, right? And you got these companies poaching the talent coming from Stanford. And you got a lot of similarities to Charlottesville. With San
Except,
Francisco and Charlottesville, frankly.
except what San Francisco doesn't have that we have is the influx of folks my age and up
Yeah, coming here.
coming here. So
Yeah.
you not only have that tech pressure, you also have the pressure of the baby boomers retiring and number 2, number 3, number 5, depending on what report you read, coming into our area. So that's on top of that particular pressure.
And then we find out yesterday that University of Virginia has 48,000 applications for the fall, the most it's ever had in the history of the
Crazy.
university. So they're accepting more students than ever into this housing ecosystem. They got to live somewhere. So the San Francisco comparison and that we're heading there fast. Do you want to? How about you want to start with that one? You agree with this? Do you think that's where we're going?
I mean, we're not California. We don't have, there's not the level of state subsidy to, that's an essential aspect of how they fund some of that. So I don't know. Do I think Charlottesville's the next San Francisco? I hope not, but who knows?
I mean, aren't people moving out of that area in droves?
Yeah, Rogan
They're
just moved to
relocating to
Texas.
places like here.
Yeah, Musk
So-
went to Texas.
Yeah.
Took
So
Tesla.
I think they're reaping kind of what they sow. You can only have price points go so high, for a small 2-bedroom home and have it be more expensive than someone could purchase a 3,000 square foot home around here or in other locations. You can only push that so far before people, may start to look elsewhere.
Now, with what you're saying, something that's not dissimilar in Northern Virginia, there's investors that are buying $1 million properties to rent to Amazon employees. So
Yeah.
that's kind of bonkers.
That's
But
bonkers.
But to put it in perspective, the numbers I crunched this morning, 2000, the average sales price was $213.
And where? The region?
So this is the region. So
Yeah.
this is our typical Charlottesville region. We do Charlottesville, Albemarle, Nelson, Greene, Flavanna, and Louisa. Only detached homes, right? No new construction. Thank you for getting me back on track. But we're at 444. That's a couple $100,000 increase in 20 years. That's a big spread on thing. And I everything I'm looking at here is even when we were hurting in the Depression, we still had eked out a little bit of a positive year over year increase in value. So, I think if you buy now, this is what I tell people, if you sit in it for that 10 years, you're going to gain this year over year, somewhere between a 3 to 6% increase. Are you guys kind of seeing that same thing, or am I a little off base on that number?
No, I think that's true. The scary part for me about what you just said there is that I wish we could look it up. What have incomes? How have they raised in percentage-wise in correlation to
Is
that?
Neil watching?
Neil Williamson is watching.
Neil, I bet you can dig that up real
What's the
quick.
question for Neil? Neil Williamson, we have a question for you. Free Enterprise Forum, Neil Williamson.
So the question is what was the average income in our area in 2000 versus now?
Yeah, I bet you he does have that answer.
I
Because
guarantee
I
it.
guarantee you, it didn't rise enough to keep up with 100 or 200% increase in home prices. So
I don't know.
That's challenging.
I can tell you the medium area.
Unless the people that are buying the homes aren't from this area or not employed in this area, which in that case, then it could have kept up. Because if you're having folks.
Yeah, but I'm sorry, go ahead.
No, please go
No,
ahead.
but then if we talk about affordable housing for this area and all
I
of
think
that, how
that's
do
a
we?
myth.
It is.
I think that is a myth.
What's
It
a
is.
myth?
I mean,
It
I know
is.
you know.
It sounds
you are
great.
committed to it. You are 100% committed to it. I love what you're doing through. I love the land trust. I think the land trust is the best solution.
My hearing
Habitat
aids
for
didn't pick
Humanity
that
is a
up.
good one. I'm choosing my words very carefully right now, as you can tell.
Yeah.
The affordable housing mantra, whether or not it's a myth.
Well, it means different things to different people, Jerry, right? What
Yeah.
you consider affordable and what I consider affordable, right? As we talk on the show, Mrs. Smith wants to move, I want to buy, or she wants to buy. I can't buy what I want for the price point that I want. I can't afford it, to be frank with you. So it means different things to different people.
You don't want a 963 square foot, adorable, charming cottage on Market Street?
The one that just went down?
Yeah, it got price
mean-
dropped 20K. I just got the notification too.
Just try, that's exactly right. 20K. Geez, I wonder why.
515 to 495.
Yeah.
We'll talk about that later. This question for you, gentlemen. Do we expect, or do you expect Nelson, Greene, Orange, Louisa, Flavanna, Waynesboro, and the other side of the mountain to absolutely continue to boom? You want to hit that one?
How does it not? I mean, when you look at what's going to be the most friendly to builders, what's going to have the greatest amount of land that is going to be subdividable, I mean, it's got to go. That is a key to opening this all up, which is what we had 20 plus years ago that we don't have now, is a more streamlined effect to get big developments done in, and the right market to do it. Right now, the cost for building materials is, just another, pin in the cushion for that. But
The short answer to that is yes, it is going on. I can tell from firsthand experience, there are literally thousands of lots coming online outside of in this drive till you qualify, or as Quentin says, fly till you qualify. So that's just what's going to go. But what was that movie that said "Follow the Money"? Oh, show me the money. That was show me the money.
That's Jerry Maguire.
Jerry Maguire. But I was close anyway. So follow the money. When you start looking at where the money's going for these larger projects outside of that, these folks are seeing it, and that's kind of where it's going to go. But I disagree with this whole, but maybe because I'm so
you're
passionate
very
about
invested in it.
Well, I'm just passionate about it, but affordable housing means different things to different people, and that's like a hard definition to nail down.
How about this question for the man who lives in Crozet? What's the next Crozet in Central Virginia? We'll ask you that question. Before we do, Susan Steinmart, Executive Director of the Land Trust, is watching.
Stop.
Yeah.
Happy birthday, Susan.
Happy birthday, Susan
Today's
Steinmart.
Susan's birthday.
Susan Steinmart is 39 years young today. Happy birthday, Susan Steinmart, 39 years old.
Happy birthday.
Yeah. She says the Thomas Jefferson Community Land Trust is now selling 15 homes this summer in Spring Hill Village to those families earning 80% of area median income or less. Thank you for sharing that
Well
with us,
done, Susan.
Susan Steinmart. Very well done. And happy 39 to you, Susan Steinmart. The next Crozet in Central Virginia, what do you think, where it is?
I guess Crozet was designated a designated growth area a long time ago, and it's coming to fruition now. The only place I see you'd have to have it off of a major corridor like 64 or 81. It's probably going to be that Shenandoah Valley area, right? So Waynesboro, Stanton, Fishersville through Harrisonburg, up and down there. I think that's where it's going to have to be. I don't know exactly where it would be. There's so much that's got to go into planning that, but it's got to be over the mountain. I don't see how it goes up 29.
What do you think?
Culpeper's seeing a huge amount of growth, and
Culpeper would be a good spot.
What about Gordonsville?
Gordonsville, well, maybe more Zions. Why not that? For one, I've got my own opinions of how Fluvanna failed itself, and let Louisa kind of take the bull by the horns with growing that, and that's 20 years, 30 years in the making. But there's certainly the opportunity. You're right. You're 25, 35 minute from Richmond, and you're 20 minutes from Charlottesville. Why doesn't that continue to grow? Then you've got water issues and some other questions, but I think all of those have solutions.
Susan says, what about Lovingston? It's got so much character.
Yeah,
and she's also saying 29 North. Could be potentially Greene County, potentially.
Greene County, particularly since they've now kind of upped their broadband plan. Look, it's Zion, and you're 100% right. It's the other side of the mountain. Yeah. That is the 1 and 2, and I flip-flop from time to time, which is in the first position, which is in the second position. I'd probably say they're pretty darn close. I can tell you, Scott, they've got the water thing kind of nailed down, so that's good. As you know, I've been involved in that for 3 decades on that end of it. And I love Jesse Rutherford to death. Yeah. Here's the problem with Lovingston.
I'll tag Jesse here. Go ahead.
From a development perspective, it's all those beautiful mountains, right? And it's almost impossible to do a development of any size to make the math work. It's just hard. So when you start looking at the other side of the mountain, you have enough of a flat area, and particularly Zion's Crossroads too, that it works. So it's these many things. But actually, I had some meetings with some folks out in Loverston trying to figure out a way to do it, and it's just really hard to find a parcel. It has the infrastructure for schools, it has the infrastructure for water, and it has the infrastructure with the road. The problem is the topographical layout. That's the struggle. The development costs would be just way off the charts.
You got the following firms watching you guys. Nest is watching, Long & Foster, Keller Williams, Yes Realty Partners.
Look at that, huh?
Christopher Eagle, welcome to the broadcast. A couple Long & Foster folks, Daniel Pettit, Mustache Dan is
the
watching
man.
from Real Estate 3, Mustache Dan Pettit. This is an interesting question. Do you guys track how many all-cash buyers are coming through today's market? Are you able to track that? Any mechanism?
Well, they wouldn't be able to do it because they would never.
They wouldn't come to you
They
guys.
wouldn't
Yeah,
get.
Yeah. Would you be able to track that?
Yeah, we can do that.
Someone wants to know the increase in all cash buyers during COVID and now compared to pre-COVID.
Yeah, we'd have to spend some time digging into that. I could tell you what it feels like. It's pretty the same. We don't really.
I think it's the same.
We don't really see a lot of cash buyers. Yona and I, right? That's-
Jesse says Livingston is open for business. The
I
Nelson
know,
County Board of
I know,
Supervisors.
Jesse. I love
is
you,
watching.
Jesse. I'm just talking from a development perspective, pure
He's
topographical.
watching. You have
He knows
You
I-
have supervisors and counselors from 4 municipalities watching.
He
this.
knows I love him to death. It's just difficult. It's you've got to find the right parcel, and that's the struggle. That's the struggle out there. Unless Jesse knows one, give me a call. But yeah, so it's I lost train of thought. I kind of lost.
The all cash buyers.
Thank you.
You
The
said
all
it was
cash-
the same. You feel like
Yeah,
it's the
it's
same
just
now.
I don't have a stat to throw at you, but it just I can tell you of the 60 something we did last year, maybe a tenth of them were cash. It's mostly finance. They're mostly finance.
Yeah, yeah. This question for the fellas: does the market start stabilizing as the new construction comes to market? That's from an agent that asked not to be named. The new construction, you've taught me this,
Yeah.
is a ways away. How far away is the new construction
We're
that would make any impact at all?
Yeah, we're so behind.
Like 18, 24 months, right?
Minimum, probably closer to 5 years. Somewhere between 0 and 5 years is what you're going to start seeing. And it'll be trickled in. You have folks like North Point that's going to be in the 1,000, 1,500 range. I can't remember the exact number off the top of my head. And these gentlemen will know this, is we went from 2006, 2007, or prior to that implosion, over 2 million new construction builds, down to 300, to 400,
We've
to
made
500
this problem.
for decades,
Yeah.
for a decade. And I think we're going to hit somewhere around 1.4, 1.5. I can't remember the number for this year that they're projecting, but we're still underproducing. And as soon as it's just going to take forever, in my opinion, a long time for that to kick in. I think Mike is spot on. I think what this is going to happen, this is never just one thing. It's these multiple different things. Interest rates going up a little bit, right? Folks feeling a little bit more comfortable in the marketplace, right? This COVID, this whole, hey, I feel good to go out. I'm shot up. I'm ready to go. That's going to play into it a little bit. The units are starting to creep up a little bit on the market. So we're going to end up with some sort of balance. When I was talking about bubble, Michael, I was talking about what I went through, right? This the real estate depression. And I really think the systems are in place. And I may be wrong, and you guys are the guys to know this. I think the systems are in place to prevent another 2000, depending on which year you want to pick, but 2007, 2008. Is that true? Is that a fair statement to make?
Yeah, I mean, the systems were put in place to prevent that type of, I guess, predatory lending that got us into that in the first place. So those are in place. So we said before, there's not a big, huge amount of subprime mortgages that are going to come due that's going to turn around and wreck the market. But you have a gradual slow with things like, for example, lumber prices, right? Lumber prices, you could get a 2x4 for $3. It's like $11 now. So who's that going to get passed on to? The consumer. What is that going to do? Is that going to slow pricing? Is that going to slow development? we're still writing tons of new construction loans. So there's got to be a breaking point at some point. You can only push the pricing limit so far before people just either can't afford it anymore, or it's cheaper to rent, right?
But we're not there yet.
We're not.
Well, the rental prices are astronomical. The rental prices are higher than a first-time
That's exactly
mortgage in a lot of ways.
Which is going to be something that kind of will come in once we get to the forbearance thing.
Did you think some landlords are going to lose their properties?
Enough of them? I mean, it depends on how many, who has tenants that haven't been paying. I mean, this all comes down to an inventory question again. Somebody's going to step in and buy them if they are.
Well, that's kind of what I was getting at, and I was trying to work my way into the forbearance conversation. Mike,
Did I derail you? I'm sorry.
No, it's okay. We're cool. But, I don't, I had some clients say, well, this forbearance is going to be the new foreclosure crisis, and I just don't see that happening. No. And the reason being is when this happened last, everybody's equity went to the toilet.
So was your client saying that we're going to have a flood of landlords putting their properties on the market because their tenants are not paying their rent? Is that what you're saying?
No, just a general question that there's a bunch of folks that have taken advantage of this forbearance, and at some point the bill's going to come due.
Sure, of course.
And we want to talk about that, what that actually means. So if you have taken advantage of forbearance, what does that back end look like? So why don't we start there, Scott? What does that look like in a typical forbearance, folks? That makes sense?
Yeah, depending on the servicer, they have the option to go into a repayment program. It's not like they're going to, on a mortgage statement, it's going to look like they owe a lump sum, but they're going to have the ability to pay that down, or some of them are going to allow it to be tacked to the end. But certainly there's going to be people who, coming out of this, probably going into it, we're still having struggles. So they're going to ask for a continuance in the forbearance. The servicer most likely is going to ask them to requalify for the mortgage. If they can't do that, then they're going to be able to face their, a process to end that with that current borrower. And I think that's, something that needs to happen. That's part of the pieces that are going to go into solving the inventory problem.
So I just read a number. 50% of the people that started at this point are already bought themselves out of it.
Yeah.
So that number, whatever that number was, and I can't remember off the top of my head, we're already 50% less than that. And I think the real reason that will not be an issue is because of this equity. So if Keith and Jonas Smith took this forbearance, and God forbid something happens and I can't make my payments, I'm going to pick up the phone and call one of those excellent realtors that's on this watching the show and say, sell my house for me, because I'm going to make a little bit of cash, and then I'm going to go get a rental, get my life back together again, and go out and buy another house. The last time you couldn't sell a house, right? You couldn't give one away back in the days. And you could just take a look at this numbers that I did back we went from pre-implosion, like 2,000 transactions happening down to 400 a year. So that was a result of that. People couldn't sell their houses.
Yeah, I don't think it's going to be a bad thing coming out of this, because, like you said, when we went through this last time, product went away, right? The ability to lend money went away. So what happened at the beginning of COVID is that happened similarly, where a lot of loan programs got pulled back, especially in the jumbo market. The jumbo market virtually disappeared overnight. Well, as things are opening back up, all those products are coming back. So we have product coming back. You have people coming out of forbearance. And this is just just a little thought I had on it, was people are coming out of it. People have had a whole year to kind of rethink where they're living, what they want in life, all of this. And there's an extreme hunger and demand for new homes. So I personally think that there's going to be a boom in the opposite direction potentially, where a lot of people are like, you know what, we want to relocate, or we want to do this, and then we're going to see more supply come on the market, and then there's going to still be that buyer demand. So I think it's not going to be off the charts, but I think it's going to keep everything at a level that we're going to be similar to where we are now, if not see numbers tick up in the next several months. So I think the point of all that is I think the housing market here is going to remain very strong from a demand standpoint, and I'm very hopeful it's going to start to pick up in a supply standpoint.
And
So this-
my point related to rentals was, for some of these people, what are they going to do? Go from a $1,500 a month mortgage to an $1,800 a month rental payment? Like,
Yeah.
that's the other thing. Like,
So to go back to the cost of construction and the lumber question, as Scott knows in particular.
Mustache Dan just put that question on the feed. The
So,
cost of lumber, cost of goods, and new construction.
correct, but this is a cyclical thing. It happens, right? I've been here, done this before. When hurricanes would happen, down, God forbid, down in Florida, plywood, all the stuff would go up through the roof. You know, you couldn't get drywall forever. Similar situation. So it's going to come back down at some point. This is a little bit more sustained than a natural disaster scenario because there's a bunch of reasons behind it. But from a new construction perspective, I'm less concerned about material costs. They'll cycle back down. It's the lack of skilled labor.
Yeah, it's the labor.
That's the real
subcontractors.
problem. I've got some hardscape work being done around my house, and the company's 3 weeks behind schedule because you can't hire anybody. You can't find anybody to hire.
I think that's going to give existing homes a lot of premium and value, because if it costs so much, if you're going to buy a new house, right, and you're building it, and it's going to cost you 30% more than you could buy an existing home that was built a few years ago, that's great. And I think that existing homeowners are recognizing that, and it's just like a perfect wave of all these circumstances coming together where people can. I think there's going to be some movement in the market because of all the things we just mentioned.
So, I mean, we had this conversation, we don't, things change, we don't take experts by, verbatim, but I read something about Ramsey this morning and some other folks. They're literally projecting this for another 10 years. And that's
The housing crunch?
Yeah, this market is not going to change much for 10 years, which, like you, Mike, I find out, come on, but we're already in a 10-year uptick, right, since this last time.
well, when you looked at the demographics prior to all the, let's say everything didn't go haywire.
Bingo.
You've got millennials coming
Bingo.
of age in order to buy housing.
Bingo.
And now you've got mortgage rates at an all-time low. So it was already forecasted to be good for 5 to 10 years, and now it's really how the government handles getting out of this. Can they pull the Band-Aid off without upsetting the apple cart? I mean, that's, in my opinion.
Brian Kolak has got a question for all three of you guys. Was 2020 the best year for all your businesses?
It was it was.
The best year in the history of your company, for you.
2020 was the best year for me personally, and 2021, already like
You're ahead.
40% ahead of last year. It's insane. I'm working 7 days a week pretty much.
So
Which is
2020, the
great.
best year for, it's great. Congratulations.
Yeah.
Yeah, you've earned it. Same for you?
Yes,
2020 is the best by far.
yes. And,
And
2021 is
Surpassed 2020.
very good.
And that's similar to 2020 was the best year of your
So
business.
general real estate, absolutely.
Yeah.
But pre-implosion on my development construction was dwarfed what's going on now.
What does that mean?
That means our volume of sales, but this is new construction. We were building 30, 40, 50.
Oh, that's when you were developing.
50 units a year, in the $300,000 to $500,000 price
Andy
range.
dealt with some of the worst employees you could have possibly had at the time.
He used to work for me.
Is that true?
You used to work.
Oh, yeah, sure.
When I got out of the Marine Corps, I framed houses for like a summer and a half.
Yeah.
Nice.
So the word work is being loosely.
This guy grinds. What are you
He did.
talking about?
He actually did good. Yeah.
I have no doubt.
Didn't you transplant the trees around my
Oh, yeah.
house?
Yeah.
I stuck them in a skid
I learned how
steer.
to do it. Now I've got a bunch of stuff in my house. I'm like, I'll just get a tree spade. And my wife's like, I think we'll get professionals to do that.
Scott. It's
true.
Joe Hout is giving you props. Cecilia Ramos, Amanda Acosta, and Colby likes what he's hearing on the program as well. The roundtable was excellent.
It is. Can we
No, please.
Can we pivot a little bit?
Yeah, let's do it.
Let's throw a little bit of this down and do a little bit of roundtable gauntlet stuff.
Oh, we're going to do the gauntlet with the
But
fellas.
a very specific subject though.
Okay.
What? Today's May the 4th. May the 4th be with you.
Yeah. You going to let them know?
I'm going to do a little Star Wars stuff.
Okay.
Best In your opinion, best Star Wars movie, Scott?
Not a movie. The show, The Mandalorian, is, in my opinion, the best.
I'd have to agree with that. But if you had to pick a Star Wars movie, what would it be?
The Force Awakens. Isn't that the second or third one or something?
I don't know many either. Scott.
Yeah,
I'm with
yeah.
you.
Okay, so apparently this is a
Yeah,
bad
two
subject.
of the four of the round table have no
The-
idea. Maybe Michael knows.
The original 3 were great. Everything
So Mike and I
after that
Yeah.
was garbage and should be stricken from the history books.
There
But-
you
Say that again,
go.
slowly.
What's that?
Say that again.
I said the original 3 movies are the greatest thing of all time, and everything that Lucas and Spielberg did after that should be stricken from history.
The man wins. The man wins a star. You're 100% right.
Susan says Empire Strikes Back.
Empire, yeah.
Yeah,
Empire
Empire.
Strikes Back.
And why is that the best one? What's the famous line, brother?
This is the hardest
your
question
father. I'm
of
your
the
father.
show. Is this
What's
Star
the
Wars?
what is it?
Yeah, he's like, I'm your father. Yeah.
Luke, I am your father.
Yeah.
Very good. I remember. I'm going to do old dude stuff here. 1977. I was a young teenager waiting in line for the first movie. But you're 100% right. Mike, you're a genius. First 3, good. The rest,
Pretty good.
trash.
What was the plot of the next ones? It was like
I don't
argumenting. They were argumenting in the Senate. That's
You know who
Ripple
knows
and
the
fun, right?
most of Star Wars in this room is Judah Wickhauer. By far.
Oh, yeah.
This guy can tell you absolutely every single fact that you want.
So what's
of
your
Star
best?
Wars.
I don't know about that. I would have to say, I don't think they can hear me, but definitely,
Empire Strikes Back?
Yeah.
Everybody says that. Okay, we'll get on a different subject. I thought we were going to have a great round table about Star Wars, and I guess I'm the only geek.
Why don't
Mike
we-
and
No,
I are the two
I
geeks.
love it. I love it. Okay,
Why don't we close with this? Okay, because that was the toughest question we just asked you with Star Wars.
Sure.
Why don't we close with this? How about a final take on the housing market for the rest of 2021? What's
Okay.
your prediction? I mean, that's what, like 7 months. That's a pretty narrow window.
Mm-hmm.
What's your prediction you're going to see for the rest of the year?
I think it's going to be very busy as things open up. People are getting a lot more comfortable, and like I said, people have had a long time to reevaluate where they want to be in life. So I think we're going to see more homes come on the market, more homes sold. It's still going to be extremely competitive, and I think rates will stay relatively stable through at least the end of the fall, going into the only concern I have is, let's say winter kicks back in, and this whole COVID lockdown stuff happens again. What will that do to the market? I don't know. I think there's going to be a lot of fatigue by then, so I think there'll be a lot of pushback. But I think the market will stay strong. I think rates will stay good. We're going to stay busy.
There you go.
Yeah, I agree. I mean, I've been saying since the beginning of the year, June is like when we see people go, this is, I'm back to living my life. Like, I'd be willing to move somewhere, and the more that you see of that, the more inventory will be available, and that I think as busy it is now, we're going to see a real spring market from like June, July forward, if that makes sense.
Yeah.
Dang. You think so?
I do.
When people get back from vacation,
It's interesting you should say that.
because it cools down at vacation time.
That's
The
already
market does.
started.
It's cooling down now?
No, the vacation, and it looks like some of we're looking at the daily price changes, and it looks like some of the prices are starting to stabilize a little bit. It'll come down to a more realistic price point. We're not doing this crazy uptick day over day on stuff. But the interesting thing is Yona and I were talking about it yesterday, just revolving around the show and these roundtables going forward. I'm having a heck of a time getting folks to come in because they're all on vacation now.
Yeah.
They're double shotted up. They're saying, right, I'm remote learning my children. I'm going to the beach for 2 weeks.
Yeah.
And which is cool. It's not so good when you're trying to get roundtables
Sure.
together, but we're starting to see that, and we're starting to see that with a few buyers that they're not saying they're taking a timeout because of the inventory or interest rates. They're taking a couple of weeks timeout to spend time with their family and go do something, which is an interesting.
That's great.
Interesting thing.
I'm happy to hear that. Last question for you comes from the agent Katie Pearl. And she wants to know your take on Greene County's ability to continue to grow.
Yeah, so that's a great question. So I think they moved a huge step forward
Broadband.
with broadband.
Yeah.
Jesse and Nelson County, we talk about this all the time. We're way ahead of this 10, 15 years before anybody else did. So they've got all that stuff in place. They're a little struggling on their water, right? And if you ever watch any of the commission meetings, the chairman will say, hey, we're struggling with this. So they're trying to work through it. So I think Greene County will start moving forward on that of it. But those two infrastructure items, that they're trying to get themselves through it. Well, other jurisdictions already knocked it out of the ballpark on that end of it.
Good knowledge. Good roundtable.
It's great. I'm looking forward to Fridays.
What's
actually.
Fridays?
Surprise?
Surprise?
Surprise.
Okay, to be determined.
No. I got it. It's just
but
going to
it's
be a
a surprise.
surprise.
Okay.
Kind of like the Star Wars roundtable.
Okay, so that's the 7th of May. It's a
Yeah.
surprise on Real Talk.
Yeah. I made a note to self. Talk to your guests before you.
Yeah, that's a good note. Thank you for doing that. I appreciate you doing that. Michael Buczynski is fantastic people. First Heritage Mortgage. Scott Morris, also fantastic people. Trusted guys in
Without
lending. This guy, a trusted guy in real estate. Yes Team Realtors and Yes Realty Partners. The show is Real Talk, and we spent an hour just talking life and real estate and how it pertains to Central Virginia. Thank you for joining us. The I Love Seville show is about 64
Who do you got
minutes away.
today?
Alex Erpy. We're going to be
Oh,
talking
cool.
rates. We're going to be talking the market.
Good.
With the CEO of Emergent Financial Services.
He's a genius.
He's a smart dude. He is a smart dude. You guys have a good one. Thank you for joining us on Real Talk. Take care. Dudes, you guys did well. I was very comfortable and relaxed.